In this section, we'll turn RWA jargon into plain language, a kind of Rosetta Stone between crypto and traditional finance. By the end, terms like tokenization, tranches, pools, and oracles should map to concrete structures you can actually reason about. Traditional finance and crypto often describe the same ideas with completely different words. Securitization, SPVs, tranches, covenants, waterfalls on one side, TVL, AMMs, smart contracts, oracles, tokenization on the other. In this course, we'll translate both vocabularies into plain language. The goal is practical. You should be able to map an asset, its legal container, its risk slices, and its data feeds, whether a deal is structured in a bank, a DAO, or both. Tokenization simply turns a legal claim or contract into a digital unit that blockchains can track and automate. The token doesn't contain the building, invoice, or machine. It encodes rights to ownership, to a slice of cash flows, or to some priority in a payout. The key question is always, which exact rights, under which law, and who enforces them if something goes wrong? Wrapping and synthetic exposure can feel similar, but they solve different problems. Wrapping asks, how do I use the same asset on another chain or protocol while still owning it directly? Synthetic exposure asks, how do I copy this asset's economic behavior without touching the real thing? With wrapping, your main risks are custody and bridge risk. With synthetics, risk shifts to collateral quality, oracle design, and the smart contracts tying everything together. A vault is best understood as three things in one: a container, a receipt, and a rules engine. First, the container is the smart contract that safely holds deposits. You don't send funds to a person or company, you send them to code. Second, the vault token acts as your receipt. It tracks your proportional share as the vault's value changes. Third, the rules engine defines everything: what assets the vault can buy, who's allowed in, what fees apply, and how returns are distributed. Pools are the basic way DeFi and RWA protocols organize money and risk. You can think of them as shared buckets governed by a simple rulebook. Capital goes in together, assets sit inside together, and everyone shares results proportionally. A pool might hold very similar assets or deliberately diversified ones. Either way, you get a fairly uniform, standardized risk profile before any tranching is added. Tranching means slicing one shared pool into different risk, return buckets. The senior tranche is designed for more conservative capital. It gets paid first, is shielded from initial losses, and in exchange usually accepts a lower yield. The junior or equity tranche sits at the other end. It's paid last, it's first in line to take losses, and because of that higher risk, it targets a higher potential return. Both tranches are claims on the same underlying assets. What changes is the order in which they get paid. You can picture the RWA structure like a fountain. Cash flows come in at the top and are allocated by a pre-agreed rulebook, the waterfall. First, operating fees and senior investors get paid. Only after they're fully covered do junior investors receive anything. In strong periods, everyone fills up. In a drought, juniors are drained first and absorb losses. That first loss roll, plus extra collateral and reserves, is what structurally protects senior tranches and keeps the system investable. An oracle is the data plumbing for RWAs. On one end, off-chain agents gather facts: prices, payments received, covenant breaches, legal events. That information flows through a data pipeline where it's cleaned, validated, and signed. On the other end, smart contracts consume that feed. They update balances, test covenants, trigger waterfalls, or pause withdrawals. If the oracle layer is wrong or delayed, every RWA token built on top can misprice risk or misallocate cash flows. You can think of these three as different kinds of truth about an asset. Price feeds are the ticker, a fast, numerical view of value, useful for liquidations and trading. Attestations are the stamp, a yes or no statement from a trusted party that a condition is met, like, this collateral actually exists. Reporting is the ledger, slower, richer disclosures about the whole portfolio, helping investors and governance understand trends, risks, and exceptions over time. When you bring real-world assets on-chain, bad data is often a bigger risk than bad code. If a single oracle lies or goes offline, The protocol can misprice assets, misroute cash flows, or even trigger liquidations. Oracle redundancy addresses this by asking, do several independent sources agree before contracts act? Cryptographic signatures then prove who actually sent each data point. On top of that, advanced proofs like proof of reserves or Merkle proofs let you verify portfolios mathematically without revealing every underlying position. Now pull it all together as a full RWA production line. It starts with messy off-chain assets, buildings, invoices, revenue contracts. Those are checked and signed off by humans and institutions, then encoded as attestations that oracles can read. Oracles feed that verified data into a smart contract vault, which pools positions and slices them into senior and junior risk layers. Finally, each slice is tokenized, so investors anywhere can hold programmable claims on those real-world cash flows. Next, you'll turn protocol documentation into a language your team can actually work with. Pick any RWA project you know, open its docs, and scan for terms like vault, tranche, SPV, deposit token, oracle, or NAV. For each term, write down 3 things in plain language: what it does, who actually controls it, and how it changes risk or cash flow for participants. That 3-part lens is how you'll decode any future RWA protocol. When you evaluate any RWA protocol, slow down and run this mental checklist. First, the asset. Know exactly what the token is a claim on, and whether exposure is direct or synthetic. Second, the structure and waterfall. Understand who sits where in the pool, how cash flows move, and who takes losses first. Third, the data. Identify the actual oracles, auditors, and attestations. And finally, the rule: if you can't explain it simply, you don't yet understand the risk.